Hey, what's up, y'all? Harry Knapp here. Got some more value for you today. So I hope this video finds you well and the algorithm promotes it enough for it to get around and change the way that people think. Take everyone's mindset from the normal 9 to 5 and find new ways to produce income and new ways to make smarter investment decisions. What kind of blows my mind is the fact that not many people know about investing in the first place, how to do it, or how to make good decisions about it. Some people do it, but they make poor choices, and if I could save some people from making some of those choices that are going to bring their account down, then I'd love to help. But I genuinely enjoy studying these things, and I think they can be very helpful for anyone that watches. So without further ado, today's topic, we're going to be talking about short-term versus long-term traders. In this channel, whenever I speak about traders, I'm going to mostly be talking about people buying and selling stocks in the hopes of achieving a profit. So today we're just going to be looking at a couple of strategies that people typically implement to try to achieve those goals. So the overall objective of both of these strategies is going to be to try to boost your bottom line. What I mean by that is that at the end of the day, your account value has grown to a point that was higher than where it was before. So each day you want to grow your account value without losing any money. The objective is simple enough, but some of the strategies on how to get there seem a little bit complicated. However, once you start to dive in and absorb a little financial knowledge, the strategies become easier to understand and simpler to do. So at the end of the day, both of these strategies can make you money. It just depends on how they're implemented. What we're going to talk about today is a couple of ways these strategies kind of play out and some of the differences between them. The first type of trader we're going to look at today is going to be the long-term trader. These traders typically have a more passive approach and implement a buy and hold strategy. Now, the buy and hold strategy often requires a little bit more patience and a little bit more emotional control. The emotional control comes in when a downturn happens. Often, it can be hard to think rationally. Whenever there's a downturn, the first thing you think is, oh my gosh, I'm going to lose all my money, I need to sell right now. But that's typically not the best decision. The best thing to usually do is whenever the market goes down, pick up some more stock because it reduces your average cost. If you buy a stock for $100 and then you buy another share when the market goes down for $50, your new cost basis is $75. So you just need the stock to go above $75 now instead of $100 for you to be profitable. And the hardest thing for people to do sometimes is to look at the market and feel that way. So that's why the emotional control really becomes important when you're a long-term trader. So the next type of trader we're going to look at today is going to be the short-term trader. The main difference between the short-term trader and the long-term trader is the frequency at which they trade. Basically just how often they're buying and selling. Short-term traders are going to require a lot more market attention. They're going to have to be more active at watching the market and making sure that their positions aren't falling. But this is something that kind of brings them comfort. They want to make sure that if the market's falling, that they're cutting their losses or taking profits while they're available. However, doing this comes with a little bit of risk though. Because if the market's falling and you cut your losses, yes, it could keep falling more and you're avoiding further losses, but it could bounce back up and you could miss out on the opportunity to make your money back rather than accepting defeat. Short-term traders will typically try to lock profits. What that means is when the stock market goes way up, they're going to try to take the gains and then move them into their account. Now, sometimes this may be a good idea and sometimes it may be a bad idea. The good idea comes in when the market is way up and they want to lock the profits because they're afraid that it's going to come back down because it's gone up so high already. However, the bad comes in when they lock the profits but the stock keeps climbing. This is why being a short-term trader requires more financial knowledge because it's hard to make the decision here. It's hard to know whether to sell or not to sell, and it requires the knowledge of things like volume, market breadth, and price action. Things that some people just don't have the understanding to really find out. But I'm gonna teach you, it's coming. So there's a couple of long-term strategies that I really want to talk about today. The first one being DCA. And what that's gonna stand for is dollar cost averaging. And dollar cost averaging is a very important tool as a long-term strategy because over time it's been proven to work. Basically, the whole concept is that you do it on a frequent basis, maybe weekly, bi-weekly, monthly. A lot of people do it on the frequency that they get paid. And every time they get paid, or however often they choose to invest, they take a portion of their income and invest it into the market. So dollar cost averaging tends to work because it keeps people invested in the market and it keeps people actively paying attention to their investments. It gives people the opportunity to average up when the market goes up and average down when the market goes down. So it creates a comfortable medium and then allows you to grow with the market, and it's going to typically outperform most other passive investments and give you a little bit more activity while building your account value and expanding your net worth, which is crucial, and that's what we're going for here. Expanded net worth. So dollar cost averaging, if the market's something that you don't want to put a whole lot of attention to, but you want to pay attention and you want to make sure your money's growing, it might be the right choice for you as a more passive style and still very likely to make you money. The next strategy I want to talk about is buying the dip. This is something that most people have probably heard. Buying the dip is basically just picking up shares whenever there's a market drop. It's a little bit different than dollar cost averaging because dollar cost averaging is based on buying at a certain frequency, weekly, bi-weekly, monthly, however often you get paid. Well, buying the dip is based on whenever the market falls, you throw some money in, however much money you might have to invest at the time. Now this strategy has been proven to work because typically the market eventually weathers the downturns and continues going up. So if you put money in and you get it at a lower cost, when the market reverses back up in a higher direction, the payoff ends up working out pretty well in your favor. Most people that buy the dip are looking to try to find a bottom on the down curve whenever the market falls. So you're looking for some sort of chart that looks like it's done this, gone up and it's falling, and this is the spot where an investor would want to buy the dip. The reason for this is because they're getting a lower average cost. They're buying down here and it's increasing the chances of their expected return. So if you buy lower, the chances of the market going back up are very high. So when the market does this, you get in at a better price point right here than you would have got in if you bought it somewhere up here or somewhere up here. This would be your ideal entry point because you profit all the way up from there, rather than being here and investing at this point and then losing money on the way down and then weathering that emotional stress and then having to wait for it to return above this level. It allows you to just enter at a low point and start profiting immediately. However, some critics of the buy the dip theory say that a bottom is very hard to find, and historically most people haven't found the perfect bottom. So there's going to be some pros and cons to this one. The pros are that every time you buy the dip, you're lowering the cost basis from where you could have gotten it at a higher point. It's giving you the opportunity to buy in a downturn, so that way it's easier for you to make money in the future. Now, one of the proponents of buying the dip theory is that whenever you buy the dip, your opportunity increases. But the criticism of the buying the dip theory is that you aren't investing as frequently, which is kind of a problem because investing frequently builds your account value, allows you to put money forward that you're not going to be touching as much, and it's going to be something that you're less likely to spend if it's invested in something. So a lot of people lean toward dollar cost averaging because it can promote account growth just from the fact that you're putting money into the market. Now, depending upon how well you implement these strategies, you're going to have a variable success rate. And obviously, the more financial knowledge you have, the better, because you have more understanding of what you're putting your money into. Warren Buffett always says, don't put your money into anything that you don't understand. So that's why we're doing this. We want to make sure that you have the financial knowledge. You want to make sure that you have the understanding of how these things work, so that way you can use them in your favor. So that's going to bring us to the final segment of this discussion, and that is, should I be a short-term trader or a long-term trader? What's better? And the answer is, there is no answer. And the reason I say that is because it really depends on your financial knowledge and your experience in the market. Some people are just better equipped to predict downturns and understand when they're coming, as opposed to others that don't have the financial education to understand what's going on in the market at the time. Both of these strategies have benefits that kind of relate to your long-term goals and objectives. If you're someone that can't really handle economic downturns or uncertainty in the market, maybe being a short-term trader is good for you, because it kind of takes away a little bit of the emotional stress that comes with weathering these downturns, and you can lock profits to make sure that your account doesn't fall when they approach. But for others of you, being a long-term trader really might be a better decision, because you might not really care about these economic downturns, and whenever we have one, you might just want to load up on more shares. but you don't really care about seeing the red in your account because you know the market's going to come back eventually. But some people just aren't as equipped to handle that mentally and handle that extra stress. So sometimes these people like to take profits and just make sure that they don't lose any money. However, most people have more success with long-term trading because if you're constantly taking profits, there are potential gains you're missing out on by selling too soon. But ultimately, the choice is yours, and I just want to take a little bit of time today to fill you in on the different kinds of trading mindsets, because some people think differently than others, and I kind of just wanted to lay out a little bit of a pathway and a little bit of a foundation to kind of help you understand that thought process just a little bit better. So thanks for tuning in today. Thanks for checking out another one of my videos. This is only my third one, but hopefully they keep improving from here. I've got a lot of stuff in the works, and I've got a lot of value coming your way. So stay tuned in, and I've got more coming to you. Have a good day. Harry Knapp signing out.